This is Indranil Pan, Chief Economist at the Yes Bank, bringing to you the podcast on Trump tariffs, its implication for the global economy with specific reference to India. This is quite an evolving story and possibly a very interesting story. During his election campaign days, Trump had promised that he would be raising tariffs on countries because he wanted to make America great again. And his thought process was that others were feeding on the revenues of the US economy. And that is what he wanted to stop. He started introducing the tariffs early on during his presidential term, which started around the 20th of the January. And he had also been promising that he would raise reciprocal tariffs on all the countries that US deals with. So finally, on 2nd of April, he brought out a list of tariffs that he would be imposing on his trading partners. And to a large extent, what we saw is that there were some countries where he had introduced a base rate of 10%, and there were a lot of other countries, including India, where the rate was as high as 50 to 55%. The critical worry or the critical target for Trump was China, and the reasons were very specific. China is one of the largest trading partners of the US, with a trade gap of around $245 to $250 billion on an annual basis. The initial tariffs that were imposed on China retaliated and increased the tariffs on goods that China was getting from the US. Subsequently, the US also once again raised tariffs on China, and China retaliated back. What we have today is, for goods coming into the US from China, the tariffs are about 145%, and for goods coming out of the US into China, the tariffs are as high as 125%. Now, having said that, there have been certain changes that have again been made to these tariff structures, which is the reciprocal tariffs that we talked about on 2nd of April. The most important change is that, having realized probably that the US consumers are to take the brunt of all these tariffs, he has actually put a pause on the reciprocal tariffs on a lot of countries, except maybe for China, and has brought it down to the basic rate of 10%. And he has given a 90-day period for negotiations to happen between these countries with the US, and these countries will therefore not be subjected to tariffs any longer, beyond maybe the basic rate of 10%. With China, the dealing was different, and because China, as I said, was doing a tit-for-tat with the US, and since the deficit of China with the US, or the surplus that China runs with the US, was the highest from a trade balance perspective, the focus has squarely now been on China. Now, effectively, what it also the tariff structure also pointed out, after these reciprocal tariffs were introduced, pharmaceuticals and energy goods were left out of this reciprocal tariff, and subsequently even electronic goods, which is one of the most important imports of US from China, has also been removed from this tariff list. Effectively, what it effectively means is that China or any other country versus the US wants to use the tariff to bring every country to the negotiation table and work out the best deal for itself. The average tariff that now US charges on a weighted average basis on various countries last year was around a 3.5%. Now it has gone up as high as 30%. This is also higher than the tariffs that were imposed during the Smoot-Hawley period of 1930. Now, taking you back into history, in 1930 an act was placed which is called the Smoot-Hawley Act, which increased the tariffs on various countries most importantly the European nations, to protect American farmers, and subsequently American manufacturers also started fighting for protection, and they were also given protection. The US economy was already under a slowdown during 1929, and what it did was aggravated that slowdown, and we have all heard stories about the Great Depression of 1930. That is what we get reminded of. From an economic theory standpoint, the problem today is that the Trump tariffs challenges one of the most important aspects of trade and economic cooperation, which is called the comparative advantage, which necessarily only means that you produce a commodity X in a certain country which has the natural resources or certain benefits vis-a-vis the other countries to produce that commodity, and you actually export it and sell it in a country which does not have the same type of benefits, either through a natural resource perspective or otherwise, to produce that commodity, and therefore prices are kept in check, which also means that consumers can access this commodity at a cheaper price. So effectively what it does, or what the Trump's tariff will do, is basically hit productivity, hit global production, slow down the US economy, and also possibly raise prices on many commodities, which will be the impact of the tariffs. It also has its implication for the financial markets. We have seen stock markets tumbling quite strongly because it challenges the productivity and challenges the profitability of the various companies across the world. It raises the prices of various commodities in terms of both the input costs, and therefore the prices of commodities go up. And in a situation where demand is weak, it becomes very difficult for companies to pass on this higher input cost to the consumers, and hence the companies will have to take the hit in terms of the profitability. Now, coming specifically to India, India is possibly a small fry in this overall mess that we are calling the tariff war. India's trade relationship with the US, if I want to put it in numbers, the trade surplus that India enjoys with the US is just 45.7 billion versus 245 billion that I mentioned for China. As a proportion of GDP, India's exports to the US is just about 1.6%. Having said that, US is quite an important market for India's exports, accounting for almost 80.6% of the total exports from India. To that extent, as the global economy slows down, India possibly is unlikely to remain unscathed. It also has to take a bit of a burden from the reciprocal tariffs that are introduced. First of all, we talk about the direct impact, which is basically the exports that we are doing to the US. That comes under pressure and that might fall. Secondly, if global growth were to actually slow down because of the implication of the tariff, the overall exports of India can slow down. And what we in our desk estimate is that there could be a realistic hit of about 0.3 to 0.4% to the GDP number for the current financial year. Slightly hazy in terms of the prices, because on one side, the global economy is now factoring in a deep slowdown and possibly a recessionary condition both in the US and also in China, which necessarily means that commodity prices which we in India use for industrial production, that comes down. Truly enough, oil prices have come down from around $75 a barrel pre-tariff to about $60 to $65 a barrel post-tariff. So that's a benefit to India. Other prices in terms of, say, very important industrial materials like copper, that has also come down quite significantly, and these could be beneficial for India. On the other hand, if other input prices actually rise, because China is a source of rare earth minerals to the rest of the world, if those prices rise, there could be some implications for India. India also has seen stock markets coming down. But having said that, I think what is really realistically happening is that Indian government is in talks with the US government to sort out this problem in terms of the trade gap that India runs with the US. In terms of the early agreements that we see, India is targeting about a $500 billion annual trade with the US by about 2030, and the first part of that agreement is likely to be done by around August-September of this year. India is also talking about increasing its agricultural imports from the US. India is talking about increasing its own labor-intensive exports to the US, while imports of manufacturing and industrial items from the US is likely to be going up. To that extent, India may be relatively buffered from these reciprocal tariffs, and the final implication of India may not be as strong as some of the other Asian countries, which are predominantly export-oriented and therefore can take a larger knock on their growth. Thank you very much for listening through.